foreign investment schemes to wait for the short that comes and then sell back, hopefully here in the next year or so, at a killing on the dollar. So this kind of foreign currency trading differentials that I think have happened on a massive scale in the last 6 to 8 years.
There's no question about it. These scenarios are happening as we speak. Offshore accounts are filling up as we speak. The rich are getting richer as we speak, and the poor are getting poorer as we speak. I was actually looking for, I don't know if I should read it on the air or not. I was, last summer I started plans to launch, to be the first Western fund manager to launch a Islamic bond fund. That is, bonds that are conforming to Islamic law, something called Sukuk bonds. And I wanted to do it out of Malta. I still want to do it out of Malta, and I would like to work with oil-producing Middle Eastern countries to refinance some of the third world's outstanding debt to the IMF or the World Bank, and I'd like to refinance them with Islamic bonds. Kind of a long scenario, and I won't go into it. But while I was in Malta, I met with a few very top-level international bankers out of the Europe and the Middle East, and I have a letter from one of them that is just scary, and it talks about this consolidation of wealth, and it talks about the increasing gap between the rich and the rest of us, and how basically most of us are living in a world of delusion most of the time. We just don't want to face economic realities. We encourage liars to tell lies, particularly about money, because we don't want to hear how our prospects are less and less hopeful. I mean, the way con men work is to tell people what they want to hear, and what we're hearing a lot from the mouths of people like Phil Graham is that everything is all right. What we're hearing a lot from George Bush is that everything is all right, and we know that isn't so. Let me just finish this quick recap on the market. Yesterday, the market collapsed by some 230 points. The drop was led by financial shares. There had been six consecutive sessions where the markets were up. This was mainly due to the price of oil being down. We talked about the markets are now moving in opposite directions as the dollar and dollar equivalents move one way, markets move the other. As oil came down, financial markets went up. Well, yesterday was both a profit-taking session, where all the money that was made in the previous 6 sessions were basically taken off the table, and financial shares led the collapse. Also yesterday, housing sales disappointed. We're now at about a 20-year low for housing sales. It doesn't look like the market is going to pick up at all. Just a quick, I promised you a quick recap of the housing bill that was passed yesterday and by the House, and it is before the Senate today. And looking to be value added to our listeners out there, I'd like to kind of recap that bill. The bill has a little something in it for everybody. The first part is what falls under the title of what I would call renegotiating your mortgage. Part of the bill is devoted to the creation of a program that allows some people out there to renegotiate their old mortgages and replace them with new fixed-rate loans lasting at least 30 years. The amounts of the new mortgages would be no more than 90% of what their property is actually worth now. So they'll have to do a new appraisal. So it's not going to be based upon the appraisal at the time of the original loan. It will be based upon today's appraisal with the lower home price. Who is eligible for this renegotiated loan? Well, first you have to have originated your troubled loan on or before January 1st of this year. If the loan in question has to do with a vacation home or an investment property, you will be ineligible. You need to verify your income, so no more Alt-A types of mortgages in the second renegotiated go-round. And you may not have done so filed for an Alt-A mortgage in the last few years. The second part of this housing bill is a break for first-time buyers. If you are buying a home for the first time, and if it is your primary residence, you are eligible for a federal tax credit of $7,500, or 10% of the purchase price, whichever is smaller. With the tax credit, you are able to subtract the credit from the total amount that you'll be borrowing through this new federal home loan program. There are two big catches to that, though. If you earn a modified gross income of more than $75,000, or $150,000 if you are a couple, and filing your tax returns jointly, then the credit starts to phase out, and there's a formula for phasing it out. There are three other parts of this home bailout bill. The next one is what falls under the title of additional deduction. If you are a homeowner who takes out the standard deduction on your federal income taxes and you do not itemize, this part of the bill is for you. You can now take advantage of a federal tax deduction of $500 or $1,000 if you're married and filing jointly. Again, this one is just pure gravy. You get it in addition to the standard deductions. There's also a part in the bill for reverse mortgage changes. Reverse mortgages allow older Americans, generally 62 and older, to get a lump sum or a monthly check that comes out of their home equity. And we've seen a lot of predatory practices in that area. That's almost a specialty of home loan abuse. These senior citizens generally do not have to pay the money back until they stop living in their homes permanently, or their heirs sell the house if they should predecease the payout of the reverse mortgage. The problem with these loans, however, is that they often come with high fees. Some salespeople pressure borrowers who are applying for the loan to purchase annuities and other long-term care insurance policies that they don't need. The housing bill attempts to address both of these issues. First, it limits origination fees on reverse mortgages at 2% of any loan up to $200,000 and 1% beyond that. The bill also explicitly excludes the purchase of annuities and other financial products and long-term care and stuff like that with the proceeds from the reverse mortgage. The two other areas that the housing bill addresses is the redefinition of jumbo loans. Often, if you want a mortgage loan with the lowest possible interest rate, it has to be small enough to be purchased by Fannie Mae or Freddie Mac from whatever bank you do business with and originate the mortgage from. With the new bill, Fannie Mae and Freddie Mac have permanent authority to buy the bigger loans in the areas with the highest housing costs. They can buy loans up to 115% of the local median home price, and they cannot buy any loans larger than $625,000. Finally, there's a provision in the bill for veterans. Lenders will have to wait 9 months instead of the usual 90 days before beginning to foreclose proceedings